Hello, everybody, and thank you for joining us today for the One and Fun team to talk through why financing is so important to your business and how to build financing costs into your everyday prices. Today, I am joined by Rob Macklin, who is a co founder of One and Fun and utterly brilliant. That's all you need to know there. And I am also joined by Bill Willcome, who is from the home improvement industry, has done what you do every single day and is going to talk about how to build it into our daily price. So, gentlemen, I'm going to pass it on over to you. Rob, do you want to kick us off with the bigger why of financing and how it affects our business, not only daily, but long term?
Absolutely. Thanks very much. So, an important thing to know about me is my background is actually as an M&A lawyer, and I've sold a lot of these large home improvement companies to private equity. And that's really what got me interested in financing because I've seen a lot of P&Ls, I've seen a lot of balance sheets, I've seen a lot of valuations. And one of the things that's fairly consistent is all of these companies that sell to private equity for high multiples, for high valuations, all utilize financing. And typically it's going to be over 50% and oftentimes as much as 70, 80%. And the reason they're doing that is really to close sales. At the end of the day, financing in the home improvement context is a sales enablement tool. That's what One and Fund and our software platform, One Look, are really designed for is a sales enablement tool. So it's very common for folks to look at these finance fees that are paid to lenders and think of them as a cost. And they certainly are a cost, and we can't diminish that. But at the end of the day, if the extra profits made by virtue of additional sales are in excess of those costs, you're actually going to be a much stronger company. So when we think about utilizing financing, there's really two main reasons. One is to close extra sales at the kitchen table. Anytime that someone can't afford a product, they're not going to tell you that they can't afford a product. They're just going to say, no, thank you. I'm going to talk to someone else, and so on and so forth. If you present financing the way that Bill can talk about and train your team to present financing, folks are more likely to say yes. And so that's why companies that finance a lot of their deals closing more sales. They're not presenting a price. It's not a $27,000 window project. It's it's $485 a month. And that's a much more palatable way for someone to afford a project. If they're on the fence of thinking about the project or they just simply can't afford it, financing is a viable opportunity for them to actually get the product that they want, need, and love and at a price that they can actually pay. The second really important reason is not only that increased close rate, but it's also a higher ticket price. So think about this context. Let's say you're a bath company and you're selling a bath system for $12,000. You can present it as $12,000 plus $1,500 of optional accessories, or you can present it as $189 a month. And hey, would you like that grab bar? Would you like that soap dispenser? Would you like that shower handle? It's going to be $4 a month. It's going to be $6 a month. It's going to be $8 a month. Those add-ons that you can say raise the average ticket price. And so if we look at the data that we've seen from what we've collected in industry averages from some of our partners, effectively offering financing is going to increase your sales close rate by several percentage points, possibly as much as 5, 6, or 7 percentage points. I would encourage you to go back and take a look at your KPIs, take a look at your financial models, take a look at your marketing costs, plug in a 40% close rate rather than a 33% close rate, and see what that does for your business. If you're going to pay 4 or 5% on these deals to get them closed for finance, you'll find very quickly that your profitability model looks much better paying a small finance fee and closing at 40% rather than 35%. Additionally, if we look across the board at the average financed volume, the average size of a finance job, what you'll see is something like a 20% lift. And that varies heavily across all industries and all product segments. But what we see consistently in every product segment, no matter what it is, finance jobs are going to be larger jobs. Now, admittedly, there's an effect because people are probably more likely to want to finance a large job. A $500 HVAC repair is not the same thing as a $50,000 window job as far as financing. But if your team is presenting financing correctly, the ability to upsell is significant. So again, go back to your models, go back to your KPIs, and put in a modest lift. Let's say if you're going to finance half of your jobs and you're going to get a 10% lift in your average ticket price, what does that do for your profitability? What does that do for your bottom line? 10% is actually, we think, quite low. We think it's more like about 19.7 on average from what we've seen. Go back and take a look at that. Plug in a 19.7% lift on your finance jobs, half of your jobs, let's say, if you can finance half of your jobs. And so if you think about that in that context, and let's say your profitability goes up, I don't know, let's say you're a $10 million company and your profitability goes from 15% to 18%. At the bottom line, that's $300,000. And for a typical, let's say, bath company that would maybe want to go to sell to private equity, you may be able to return, let's say, 6 times that amount on your sale price multiple. So by offering financing, you could add $1.5 million, $2 million to the value of a $10 million revenue company quite easily. And as you grow and grow and grow, that number only gets bigger. So that's why we see all of the large companies that sell private equity in particular use financing heavily. And I reference that not because I'm suggesting you sell your company to private equity, but it's a very good way to see how a third party will look at the value of your company. People who are actually buying companies in the marketplace look at companies that finance jobs, and they value them because they know that they're squeezing the maximum they can out of all of their opportunities. At the end of the day, you only get so many leads in a day. You need to close as many of those leads as you possibly can, and you need to close those leads at the highest ticket price you possibly can. If you do those two things, and there are a lot of components that go into that, sales rep training, quality of your product, and so forth. But an easy one to add on, an easy one that every company can add on is simply financing. If you're able to do that, you can really supercharge the growth of your business.
Absolutely. You called out a lot of really valuable points there, Rob. Not only are you increasing your ticket price, you're increasing ratio, how that's hitting your bottom line and your KPIs. One thing that wasn't said, but it's really important, is even the satisfaction and the happiness of your sales team, right? If they're able to close more deals, they're probably not looking to go sell for your competitor. So that's a whole nother topic for another day, but you covered a ton of critical points there. Bill, will you take us through how one could build this into their everyday pricing if they haven't been down
Yes,
this road
absolutely.
before?
Because for me, coming from the home improvement industry and managing my sales team, it was very, very important to keep the process simple, simple and consistent. So in doing so, instead of having to have my team worry about what those dealer fees were and what are their chops and all that confusing stuff, what we did is we priced it into our costs, and it made it very easy for our sales rep to present monthly payments without having to worry about what it's going to cost, right? So I'm going to share some information here. You're probably going to want to listen to this, and you're probably wondering, do you have something that can help us, figure out what these costs are going to be or what type of a price increase we need to take, right? We do have a worksheet that you'll be able to reach out to us about and work through these numbers. For the most part, we talk credit card fees first. Average credit card fee is typically right around 3%, which is kind of industry standard, along with, a 1% ACH fee, whatever it might be. But we do have credit card processing built onto our platform too, where you can get a 2.89% along with a 1% ACH fee. But credit cards typically apply to about 10% of your total sales. So what you want to do to find the impact of your total sales is take that 2.89% in this example, times that by 10% to get your 0.289%. And this means that credit card fees are going to contribute 0.289% to the total cost. Now you take the financing fees. Financing fees are typically on average right around 8%, and they're going to apply to about 50% of your sales. To find that impact of the overall sales, you'll take 8% times 50% to equal 4% of your total sales. Or this means that those financing fees contribute to 4% of that total cost. Now, once you combine the contributions from both fees to find that total impact, you'll take that 0.289% plus 4% to get a total of 4.289%. Now, when you take a look at the total increase that you need to take to help build that cost into your P&L, the price increase that would be needed is approximately 5% to cover the total fees to maintain your profitability across all sales. So it keeps it very simple to do this without having to worry about how much is this going to cost. And then also, for those customers that choose not to finance for whatever reason, that's totally fine. That profitability also helps you with your marketing costs, with future expenses, whatever it might be, to help you be more profitable in the long run as well. So you're probably going to want to re-listen to that. And if you want, you can always reach out to us to get that worksheet to help you build in the costs to make sure that you're setting yourself up for success. It's a lot easier than what a lot of people think.
Sure. Rob, this is also one of your areas. Was there anything you wanted to layer on that before we jump off this call?
No, I think Bill said it right. Building your financing fees into your pricing model is critical. And I know that a lot of companies, Bill intimated, will try to manage rep commissions based on financing fees. But I have to say, in my experience of selling several $1 billion of companies to private and strategic buyers, I've never seen a successful company that actually tried to cut their reps commission because the rep wanted to use a sales tool. If you've approved the financing tool, let your reps use it. Build it into your pricing model. Don't discourage the reps from using financing, because at the end of the day, you want the rep to upsell their project. You're better off selling a $12,000 project than a $10,000 project, and allowing the rep to sell that higher price project because you're not punishing the rep for using financing. So it's definitely a negative to punish the reps for financing. And, Bill and his team can absolutely help you work through that language, how to sell it. And the credit card and the blended cost of loan financing is critical to look at. And obviously those numbers are going to vary by industry and by what you want to do. The last thing I'd say, we didn't talk necessarily about marketing. I would say if you're whatever area you're in, look around at all the big guys around you and see how they advertise. And I guarantee you that all of them are advertising their financing programs that they have. So it's just a critical lead generation tool as well as a sales tool.
Absolutely. Well, thank you, gentlemen, for joining me today to talk through this critical topic. Thank you for listening today. And again, if you have more questions, feel free to email sales@oneandfund.com. That's the number 1andfund.com. We are happy to connect with you and leverage all the expertise on the team to help you grow your business.